I'm Charlotte McLeod with investingnews.com, and here today with me is Jordan Roy-Byrne. He is a chartered market technician and master of financial and technical analysis. He's also editor and publisher of The Daily Gold. Thank you so much for being here. Great to have you.
Well, thank you so much for having me, Charlotte. It's my pleasure.
Really good to be speaking with you, especially because we've had some very exciting and interesting price moves for gold recently, including a move briefly past 2,400. So, of course, it's retreated since then, but I thought where we could start is what caused for you that big move and now the pullback?
Well, I think the cause, I don't know if there's like a specific cause. I mean, the boring term would be technical analysts. They tell you market supply and demand. And so we had, in the last 3.5 years, we had this consolidation where, the bulls were starting to slowly gain control, but they couldn't push the market to a breakout yet. You have all this buying from overseas, central banks, Asian demand, all of that. And, it could be, very recently, it could be the budget in the U.S. and specifically the interest on the debt, where it's getting to, it's kind of reaching a threshold, you could say, where it's starting to go vertical. And basically the problem with that is at some point in the next couple of years, we may have to do yield curve control where we print money to hold interest rates down. And of course, Japan has been doing that I think since 2016, actually. And we did that in World War II from 1942 to 1951. There was huge inflation during that period. Of course, we were on the gold standard, so gold wasn't freely traded. So I think you have that specific reason. And then secondly, I'd also say the technical setup. You had this 13-year super bullish cup and handle pattern. And so the market was really set up where if you could just get enough buying to push it above 2,100, that could carry beyond that pretty quickly. And that's what we've seen. So, I'm not one to mince words. And, we talked about it beforehand. This is an industry where a lot of people get hyperbolic about, gold targets, which seem pie in the sky. But this is actually one of those times because gold has broken out of a 13-year super bullish cup and handle pattern. And you just don't see that many things like this in just numerous markets as a whole. You don't see these many breakouts. And when they do happen, they're hugely significant, not only just immediately, but also if you're looking in the next 3, 5, 7, 10 years. So this is one of those points where the market, precious metals specifically, they're in a super bullish position right now. And we could see some huge moves over the next couple years.
Okay, very, very interesting and reassuring to hear you say that, because it does feel like we're in uncharted territory here. So I want to talk a little bit about a post that you had made recently on your website. So you had mentioned we saw gold go past 2,400. It's now pulled back. And in this post, you're explaining that when we see these pullbacks after a major price move like that, they actually don't tend to last very long. So I wondered if you could go into that and kind of set the stage there.
Yeah, I was looking at the history of gold and when it has made a breakout to a new all-time high. And so I was studying the price action around those breakouts, after those breakouts. There were some breakouts, like 2005 was a really, really significant one. It wasn't at an all-time high, but that was really significant because it broke out of like a kind of a sideways to slightly down trend line since the early 80s. So I threw that one in as well. But at least initially in these moves, what you tend to see is gold, when it's running, when it pulls back, it only comes back to the 50-day moving average. In not every case, but in most cases. And so it's it's not a prediction, but it's very possible that moving forward for the rest of this year, the pullbacks will be short and we won't see gold go below the 50-day moving average. Now, if gold gets up to, let's say 2,700 later in the year, 2,800, then it could be at a point where it's moved quite a lot. And at that point, it might be ripe for a bigger pullback. Like that's when you could possibly see gold pull back, I don't know, $200, $250, maybe $300, something like that. But here and now, we're way too early into the move, and gold has not moved enough. I mean, even though I think it was in the 1800, there was a low there in last October. So, I mean, it has had a decent move since then, but historically, it doesn't have a bigger correction until it gets, really until it makes a much bigger move in that kind of a time frame. So it's just something people need to understand. It's kind of true for all markets. Like when a market makes a major breakout, when it's in breakout mode, as I like to say, when it's trending super bullish, and you're still kind of early in that move, you're not like a year or 2 years or 9 months. When you're in that, everybody's worried because, oh, the market's so hot and I'm waiting for a pullback because it's so hot, it has to pull back. But that's how that's how the structure of the market, like the regime, as people like to say, we've seen a regime change. That changes right away, but then the psychology of most people does not change quick enough. I mean, psychology and sentiment follows price action. It's only until something has moved a lot more significantly than gold has at this point that then the psychology of market participants tends to catch up. So we're in a new, we're in a new bull market. We're in a new secular bull market. We've had this hugely significant breakout from a 13-year pattern. And there's still, a lot of people are like, yeah, gold's broken out, but, you got to be careful because it, it could pull back or it doesn't, the stock market's doing fine. Gold's going to pull back. It's going to have this big correction at some point. But historically, when you look at how markets perform after major breakouts, initially, you don't get big pullbacks. Like they're short and swift. So we have to understand that going forward over the next 3 to 6 months, I'd say.
Okay, I'm glad you brought up sentiment because I had a note to ask you for your take on that because I'm feeling the same thing, and maybe it's just in myself where I look at this in disbelief and it makes me feel nervous. So when do you think we might see that sentiment shift for real and maybe pick up some more mainstream interest in gold?
Yeah, it's a really good question. A couple answers. One, I'd say higher prices. That always helps. I mean, if we see gold continue to move and we're into the summer and the fall and we have, 27, 2,800, that's certainly going to help. But also, if we look at gold against the stock market, the stock market, I mean, this is like a big picture, a very big picture view, but it surprised me a little bit. I thought we would need to see more weakness in the stock market for gold to break out. And of course, gold was able to break out with the stock market still around all-time highs. And, that basically hasn't happened. You have to go back to the 1960s. And if you use gold stocks as a proxy, that's really the best comparison to where we are, 1965, 66, I'd say. But the larger point, the more important point is when you see more weakness in the stock market, that's when you're going to see more, more retail and more generalists, more normies, as some people like to say. When that happens, you're going to see more of those types buying into the gold ETFs, and then general sentiment that's going to be much more positive for gold. And of course, that's probably going to coincide with 27, 2,800 gold. So if you get that move in gold just up a couple hundred more bucks, and at the same time, the stock market's weak, maybe it's corrected 15% or something like that. That's going to be really powerful. That will place or not place, that is going to be a catalyst for more, conventional investors putting that money into gold.
Right. And I know we're focused on the gold, but just because you bring up the stock market, I think I should ask you for your general outlook there. Are we heading toward this long-awaited recession that I keep hearing about? Something else? What are your thoughts there broadly?
Yeah, I mean, it's just a guess, but I would think maybe at some point in the next 12 to 18 months that we could see a recession. Certainly, if you look at, short-term inflation indicators are coming down, but long-term inflation indicators are actually turning up. So it's a bit unusual. But then when you look at what's happening in the markets, gold, obviously, copper is doing really well. It's starting to attack some technical resistance. Oil has turned up. So, you could kind of get a bout of stagflation in the next 12 or 18 months, possibly before you get a recession. So at some point we'll get a recession, probably in the next year or two would be my guess, maybe sooner. So I think it's definitely coming and that will hurt the stock market, but who knows, maybe maybe that's not, maybe that's 9 or 12 or still 15 months away. I don't know, but that's kind of what my general sense is, that it's coming, but not imminent.
Okay, okay. Thank you for going into that. And if we go back to gold in 2024, I know you've mentioned a number of numbers, but maybe just help me put it into perspective. So this year, what are you seeing in terms of, from a technical perspective, upside and downside for gold?
Well, I'll do the downside first. Gold has had 6 major breakouts in its history, 6 or 7. I mean, if you count when we went off the gold standard, that could also be counted as a breakout. But I think in 2 of these cases, you did have a full retest of the breakout. This happens in markets sometimes, where you get the really strong breakout, but then you quickly come back and retest what was previous resistance. So that would be 2100. If gold does a retest, maybe it comes back to 2150, 2120, something like that. So to me, that's really the downside technical case. I don't think that's going to happen, but it has happened before. It did happen in 1976 when the market, it had a really strong, it had that 45% decline, I think in 75 to 76. And so it had a long way to climb to get back to resistance. So it broke above 200. That move was very quick to 200 and then to, I think, 240. Then it had a really quick 20% decline where it came right back to the breakout point. And then, of course, it went parabolic after that. So that's one example in gold's history. That, to me, would be the downside case. Again, I don't think that's going to happen. I could be wrong, but it's certainly in the realm of possibility. The bullish case, the interesting thing is that we talked about gold making this 13-year super bullish cup and handle. So the handle was 3.5 years. If you look at the handle, there are actually 2 mini cup and handles potentially in the handle itself. So this is like I'm nerding out here because I'm a technical analyst. This is like, this is like chart porn for me, where you have this 13-year pattern, and then inside of the pattern, there's 2 mini cup and handles. But what we need to know is the measured upside target for those 2 mini cup and handles are, I think, one of them is 2350. The other is 2,500. So you have those, and then you have the measured upside target of the cup and handle. Depending on how you measure it, I mean, it's, some people are saying 2,900, 2,850. I mean, for me, I think it's around 3,000. So that to me would be, maybe we have a chance to get to 3,000 by the end of the year. Another thing is, if you look at these patterns and you take what I call the log target, which is the percentage depth of the handle, because the measured upside target, you're just taking the depth of the handle, which is around $1,000, and then you're projecting it on top of the resistance. So that's how you get 2,900 or 3,000. But if you take the percentage, that, depending on how you measure it, you can get anywhere from 3,700 to, I think, like nearly 4,100. And historical cup and handle patterns, which, and these are not perfect patterns, but the historical ones I looked at, and there's not that many, the market went from the measured upside to the log target in 6 to 12 months. So if we get to 3,000, or, when we get to 3,000, based on that history, you could say, okay, well, maybe we're in a 6 to 12 month scenario where gold could hit 4,000 after that. So yes, this stuff does sound extreme, but there's real science to technical analysis that goes into these upside targets. So to button up a long answer, you have 2,500, and then you have 3,000 for me is the next target after that. I mean, there is a Fibonacci target. I want to say 2,750. So it's possible we could stop there and have more of a correction before we go to 3,000. But bigger picture, I'm looking at 3,000 and then 4,000 after that.
Okay. For me, it really helps to get the upside and the downside. I know that some people just want to hear a concrete answer, but I do like to look at it from all the different sides. So thank you for that. And I think you started going toward my next question, which was, when we last spoke about a year ago, you had outlined a scenario where we get to $4,000 gold by 2025. And I was going to ask if that is still in the cards. And it sounds like, yes, there is still a way to get there in that time frame.
Yeah, it's still in the cards, although I'd add some time to it because that was based on gold breaking out last year. And I think if I recall our interview correct, you said, well, what could go wrong? What could derail this forecast? And I think I mentioned it could be a timing thing where it takes a lot longer than I think, and that other people think. And so it was. I think we did the interview in April, so we're looking at to maybe 9, 10, 10, 11 months since we had this breakout move. So that pushes out that forecast, I would say. Still on the table, but yeah, I think it's possible that we could hit 4,000 by the end of 2025. I was looking at I'm going to publish a video later today, but I was looking at another person, sentimenttrader.com. They were putting out they put out a chart based on gold achieving really strong momentum. Like they were marking all the points where it spent more than half the month making a new all-time high. And so I looked at that, and then I said, okay, well, where are the points that are after major breakouts? Because we just had a major breakout. So there were two. There was one after the breakout in 76, and then after the breakout, I think fall of 2009. And the fall of 2009 is obviously the weaker of those two moves. But even on that move, like if we duplicated that move after that breakout, gold could hit 3,700 in December of next year. So there's more than one thing that are pointing to that. I mean, it's obvious it's a timing question, but I do think that gold. I mean, the setting is really ripe for these targets to be hit in the next few years.
Okay. Yeah, it's really interesting because we've been talking about how people feel like it's moving too fast, but in a way, we've been talking about this for such a long time. So is it fast or is it slow? Hard to say. Okay, so going back to investors, I was going to ask you, what should investors do in this scenario? Of course, every person is different and they should figure out their own strategy. But, if you have your gold, should you sit tight right now? Should you consider buying on pullbacks? What's your take on that?
Yeah, I would say, I mean, we're clearly in a new bull market now. It's buy and hold. So you don't want to be a seller. Well, I mean, when we're talking about physical metals, you're in a buy and hold. I mean, when we're talking about the stocks, that's completely different. Sometimes in the stocks, you get those really sharp moves. I like to call them rhino horns. When you're looking at the chart and you can see it looks like a rhino horn because the move is so sharp. If you're in the stocks and you get that kind of move, certainly take some money off the table. But everyone needs to have a plan because precious metals they're different from the stock market where you're in a secular bull market, the stock market, and it will just generally slowly move higher over time. Precious metals are a lot different. You get really sharp moves, and then you get a consolidation or correction for a year or two. Then you get another sharp move. So you need to really have a plan to figure out, okay, as the market moves higher, am I going to buy more? When am I going to take some profits? And so that's the hard part. The easier part is knowing we're in a bull market and that, gold and silver have potential to move dramatically higher. And it can get scary when they start to move vertical. So I mean, that's the easier part. The harder part is each person has to figure out their own plan. When am I going to take some profits? When am I going to buy more? And like you said, everyone's different. So the answer for everyone is different.
Yeah, definitely a very individual consideration. But okay, so you started to talk about the gold stocks and how they're very different from the physical metals, of course. So certainly we should take a look at what's going on with the gold stocks. I looked at GDX and GDXJ before we started this interview. They are up year to date. I know they're not representative of the whole gold sector. That's what I was looking at there. So I know they've moved, but investors would like to see them move more. So I'm wondering what you're seeing there and when we may start to see more moves in the gold stocks as people, I think, are expecting in this environment.
Yes, I think we will see more moves and some significant moves. If we step back for a second and think about gold stocks and how they perform, they're really options on the price of gold. Now, in 2006, you had the introduction of gold ETFs. Now, before that point, you couldn't, most fund managers, investors, gold was not financialized. So before 2006, if you wanted exposure to precious metals, you really had to buy the stocks. Like that was all you could buy. And so the introduction of the gold ETFs, that has completely changed the setup between gold and the gold stocks. So now gold is the driver because generalist money, they buy gold first. Then, later on, if you twist their arm, maybe they'll buy silver or they'll buy the gold stock ETFs. But so because of that, the gold stocks they're an option on gold. So they're nothing more. Think of them, and it goes for silver stocks as well. They're options on metals prices. So options do the best when you have the most significant moves in metals prices in a shorter period of time. So there's a couple times when the stocks will really outperform, as a group. The first is after you get a major breakout in gold and silver. So after a major breakout, historically, that's when they perform the best. That's when they really outperform the metals. Now, also, if you're coming off of a crash bottom, like say 2008 or COVID in 2020, so you're coming off of a crash bottom and you get these really sharp rebounds in metals, those are the other times when the stocks will really outperform. So here and now, we're coming off of a gold breakout. This is the real sweet spot for the stocks to outperform. Now, they're not going to outperform, permanently moving forward. They tend to really outperform at the beginning of the moves. So if we're going to see, like, let's say gold will move to 3,000 before it has, like, let's say a $300 or $400 pullback at 3,000. As gold is approaching 3,000, that's when the miners will start to lose leverage, like an option. So the closer gold gets to that resistance point, then we'll start to see miners will not perform as well. And so, that's like it just one scenario in a short-term sense, in that the miners, they leverage the moves best at the beginning of the moves, but once you kind of slowly you're getting closer to the end of the move, like that's when the leverage from the miners will really trail off. That's something I like in a very short-term sense. If we look at gold and silver right now, I think we could see a short-term pullback. And if you look at the stocks in the last 2 or 3 days, they have been starting to weaken, whereas the metals are still strong. Like you have, there's a bit of a geopolitical bid and that sort of thing. But so in a very short-term sense, we're seeing the metals are starting to cool off. So that could be a signal of like a short-term correction here. But that's the Cliff Notes version to my long answer is the stocks, they trade like options. So they leverage the moves in the metals. But when you're breaking out, you're in a real sweet spot. So, silver has resistance at 26, also some resistance at 28. So if we see silver break 28, that's a real sweet spot for the silver stocks to really outperform. So I think like the next leg in silver, where you get a move from like say 28 to 34, like you could see the silver stocks really strongly outperform during that move because it'll be coming after a major breakout.
Okay. I'm going to come back to silver in just a moment. But before we go there, I wondered if there's more you can say about how the introduction of gold ETFs changed the landscape in terms of, people going into gold stocks. Because I only started this job in 2012. So for me, gold ETFs, they've been there all along, and that's less familiar for me.
Yeah, it's really interesting because if you look at gold stocks and you look at, I love to look at, 100-year, 50-year, 70-year charts. And if you look at, gold stocks relative to the stock market, or you look at some of their valuation, it's hard to get valuation charts going back that far. But gold stocks, they traded at much higher valuations, like in the 80s and the 90s, even though gold was not in a secular bull market. So they traded at much higher valuations. And so this introduction of the gold ETFs and financializing gold, as some people like to say, that really hurt the gold stocks. Because since then their valuations have come down significantly. So it's really hurt the entire mining sector, because beforehand it'd be such a pain for fund managers and retail investors. Again, if they wanted exposure to gold, they really couldn't buy gold pre-2005, 2006. So they just said, okay, well, I'll buy gold stocks and I'll look at the biggest miners. And so the introduction of the ETFs, they don't even care about the stocks anymore. They can just buy gold. And so that hurt the stocks, that it's caused their valuations to really plummet in the last 15 years. But what nobody points out is we've been in a secular bear market for precious metals. I know gold has gone sideways, but if you look at the gold stocks, you look at silver, they're way below the 2011 highs. Gold had not really broken out until earlier this year, a couple months ago. So we were in a secular bear market for precious metals until the last few months. That also hurt the gold stocks a lot. Now, I don't think, now that we're in a new secular bull, I don't think we're going to see valuations on the gold stocks get back to where they were in 1980 or even the 80s and the 90s. But, we're in a new secular bull market. So maybe at some point in the next 5, 7, or 10 years, maybe they get close to that point. But irregardless, the introduction of the gold ETFs as a way of financializing gold, that really hurt the mining sector.
Okay, thank you. Thank you for going into that. I think it's interesting to get that historical perspective. And so now over to silver. So silver, very interesting to me. So gold is making these historic all-time highs, and silver is much below its all-time high price. So I wondered if we could look at silver in 2024 and I guess the important levels that you're seeing for silver at the moment.
Yeah, the most important levels are 26, which we've taken out. And then you have some resistance at 28.5, 29. We're looking at daily and weekly charts. There's some resistance there. And then 34, like around that area. So silver has, it's kind of made this inverse head and shoulders pattern over the last 2 or 3 years. It's not like a perfectly textbook pattern, but, nevertheless, if that does play out, you have a measured upside target of around 34. And, yesterday I was looking at quarterly charts, monthly charts, and yearly charts. And so those are all pointing to 32, 34, 35. They're pointing to that area as the next stiffest resistance. And I think the resistance in that area is probably going to be more significant than the $50 resistance. So you're thinking about, okay, well, when could we get a big pullback in silver and gold? We don't know at this point, and I'm getting ahead of myself, but maybe at 34 silver, $34 silver, maybe that's when you see silver pull back to 30 or 29, possibly. But here and now, silver has cleared 26, which is really important resistance. Then you have that 28, 29 area. And actually, at the end of last week, the weekly close in silver was an 11-year high. So it actually had a little breakout. So nobody seems to be talking about that. But, maybe it'll take more time to confirm that. But that's where we are for silver. Right now, silver should have really strong support at 26. If it does its own little retest of that breakout, which is very possible, and so you have this resistance around 29, then you have 34. Like that's going to be an area of really strong resistance. I would be surprised if silver blew through 34 right away. Like I'm saying, if precious metals stay really hot and they keep moving higher, then I think that raises the odds where you could get a pullback in silver, after it hits 34. But yeah, and then of course you have 50, and if whenever silver breaks 34 and it starts running back to 50, I mean, you're set. This technical base, we're closing in on like a 45-year base where it would be, I think, the third time silver has approached or tested $50. So whenever silver breaks above 50, to me, that could be the biggest breakout of all time. And again, that's not hyperbolic, because you rarely see a market where there's like a 40 or a 50-year base where it's tested it multiple times. Like I'd really have to sit down and like go through thousands of charts to see that. Now, cocoa, which I think cocoa was like a 40, 45-year base, pretty similar. So that's something to keep in mind. But yeah, so 34 for silver, that's the next strong target. But things could get kind of nuts when silver is approaching that breakout at 50.
And the 34, is that an area that you think we get to in 2024, or is that more looking forward?
Good question. Let's see, how many months do we have left in the year? About 8.5 months. It's possible at this point. I'd have to look at the gold silver ratio and do some comparisons. But I would lean towards yes. I think it could hit that this year. I don't know what target that corresponds to for gold. Maybe it's 2,800 for gold or 3,000. But normally you have the gold breakout first, and then in the next couple months or 9 months, they're all different. Silver makes a breakout, and then after silver breaks out, it really starts to outperform. The problem now is the silver breakout at 26, which we just had, or is it breaking above 28 or 29? So it's not clear. If we didn't have resistance at 28 or 29, it would be more predictable. But we are, either way, I would say we're entering the point, or we're getting really close to it, where silver could really outperform gold. Because again, usually you have the gold breakout first, then when silver breaks out, after that point is when silver really starts to outperform gold. So, you could say 26 was the breakout, or if that's wrong, maybe silver has to break above 28 or 29. But again, either way, silver is really close.
Okay, silver, very tricky. And I have one more question on silver. I know we're looking at this from a technical perspective, and we hear, silver will lag behind gold, and then it will move, then it will outperform. This is what usually happens. But silver has got its industrial side, and I keep hearing more on the industrial side as well, especially when it comes to applications in solar. So for you, how are you weighing that industrial side of silver into all of this?
To me, I weigh it 0. And I'll tell you why. Because historically, when you go back and you look at you look at the last 50, 60, all these years of price action, silver basically performs best after gold breaks out. The biggest breakouts in gold, that's when silver has had the best moves. Now, maybe something will change over the years ahead, but silver itself, before we said the miners are basically an option on gold, silver is actually the same. Like, silver itself is an option on gold with the way it moves, because if gold is consolidating or correcting and not doing much, silver really underperforms gold, regardless of what all the industrial, regardless of those numbers. But if gold is trending higher, if gold makes a huge breakout, those are the points when you get the strongest moves in silver. So again, I could be wrong. Maybe something will change. Occasionally you do have a significant change in markets. It's going to be hard to know if that's actually happening. But for me, I lean towards the history, and that it says that silver is it's an option on gold. And that when gold breaks out and gold's doing really well, that's when silver is ripe to perform even better. So I was looking at the last couple of years, I was looking at some of the industry, the supply and demand and all those types of things. But, the market didn't break out. It wasn't doing well. And you see the same thing for gold. Like, the best years in gold and silver, they perform the best when it's investment demand, when you have the huge investment demand. When they're not doing well, you can look, and regardless of what the supply and demand stuff shows you, the investment demand is really low at those points. So investment demand is the real driver for both. And so, like I said, based on the history, the industrial stuff for silver, I know I probably disagree with most people you interview, but for me, I weigh that 0. Doesn't mean anything for me right now. And by the way, silver doesn't need any of that to have this spectacular bull market and make these huge moves. Doesn't matter at all, because based on the history, if you think gold's going a lot higher, silver will follow.
Okay. It's always interesting to hear opposing perspectives, and I can think of at least one person who thinks the same thing about silver, so you're not totally alone. I think that's everything I had for you today on gold and silver, the stocks. But if you had any final points that you would want to leave investors with right now would be the time.
Thank you. Gosh, that's kind of difficult, because I think I may have said before, I like to talk, so it's hard to summarize, but we are in the real sweet spot for what is the biggest breakout for gold in the last 50 years. This is the biggest breakout, starting the biggest move that it's had, since we went off the gold standard in 1971. So I think we talked before, and I may have mentioned it earlier. This is the time where, like, a lot of the hyperbolic statements that people like me make and have been making for the last 3 or 4 years, this is the time where it's really ripe for those things actually to play out. I mean, the technicals and, we can see the fundamentals. This is the real sweet spot that people have been waiting for years, and in some cases, decades. And so that's the easy part. The hard part will be keeping the money that you're going to make. So everybody needs to sit down and make their own plan and figure it out, because these markets over the years ahead are going to make spectacular moves, but you will see increasing volatility on both sides. And, therefore, you really need to make yourself a plan and figure it out, because if you don't have a plan, when you're in the moment, you're not going to know what to do. You're going to sell at the wrong time. You're going to buy a lot more when you should be taking profits. So to avoid all those mistakes and keep your emotions out of it, figure out your own plan.
Okay. I think that's a great place to wrap it up. Make a plan. We're going to leave it there for now. Thank you so much for coming on to explain everything that's going on in the precious metals markets right now.
Oh, my pleasure. Thank you so much for having me.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Jordan Roy-Byrne with The Daily Gold. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.